This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, as we saw in the previous chapter, any depreciation charges on capital expenditure incurred during any accounting period and continuing thereafter will be disallowed. We do not allow the depreciation charge for taxation, but in its place, we said, and now we see it here in Chapter 5, we have the system by which HMRC do give tax relief for capital expenditure. Here in this chapter, that which is incurred by an unincorporated trader, again the sole trader or the partnership. What we'll see in our later chapters on corporate tax is that we also have capital allowances that apply there, where although some of the rules that we will see in this chapter still do apply, there are some new and very specific rules that only apply in corporate tax. So what have we got here? As we've said, our capital allowances replace the disallowed depreciation charge in that adjustment of profits, giving tax relief against trading profits in respect of expenditure incurred on. What we said was that we would have depreciation charges on capital expenditure. What we'll see that we now have to define that capital expenditure in terms of what type. And to begin with, the capital allowances that we will look at will be those available on what we call as qualifying plant and machinery. What we must understand is simply because in an adjustment of trading profit, we may have disallowed an item of expenditure because it is capital, does not then create the right to have capital allowances thereon. Capital expenditure it may be, but it must be qualifying capital expenditure in relation to the type of capital allowances that are available. And those allowances available, we will see, the majority of this chapter is based on qualifying plant and machinery, as we'll also discuss later in the chapter, but we'll see mention of it in a moment's time. If we have a qualifying cost of a commercial building, then there's something called a structures and buildings allowance that may be available there. So, we are taking the depreciation charge, disallowing it in adjustment of profits, and now, separate exercise here, putting together a capital allowances computation. And that will be available on the cost, we said, of qualifying plant and machinery. We'll talk about that in a moment, and we'll see that plant and machinery is a pretty all-consuming concept here when it comes to capital allowances. But also, which is later in this chapter, a relatively newly introduced anyway, structures and buildings allowance, or SBA as we'll then know it as. And that will be available on the qualifying cost of a qualifying commercial building. Again, I make the point, just because expenditure may be defined as capital for purposes of adjustment of profit does not automatically equate to the availability of capital allowances in place of that disallowed depreciation charge. We must have qualifying costs of qualifying plant and machinery, and then in turn commercial buildings. Plant we generally define as assets that perform an active function in the business, something with which the trade is carried on. So something with which the trade is carried on rather than something in which the trade is carried on. With which the trade is carried on, that is plant and machinery. And it will include office furniture and equipment. So we're not just thinking about, when you think about plant and machinery, you probably think about, well, something in a factory there, in an industrial landscape. But it isn't just that. Obviously, it will. The plant and machinery in the factory, in the warehouse, that will be available. But here, office furniture and equipment, including movable office partitioning. That's an odd one to put in as an example. But it illustrates here something with which the trade is carried on as compared to something in which the trade is carried on. So if it was fixed office partitioning there, that's a part of the property that therefore represents something in which the trade is carried on rather than with which the trade is carried on. Machinery will also include here motor vehicles. Yeah, not just the plant and machinery in the factory, not just the office furniture within the office buildings there, but also motor vehicles and computers, including even the building alterations necessary for the installation of plant and machinery. Again, it might be a major item of plant that we have acquired, and we have to carry out, again, costs there are incurred in terms of building alterations in order to put that item of plant into place in the factory. The plant and machinery capital allowances are not available on the cost of a building, but are available on integral features of a building. So integral features of a building, again, there's a list of these that we will see just a little bit later, where they have special rules in relation to what capital allowances are available for them. But they would include things like lifts and escalators, electrical systems, heating, and indeed air cooling systems there. So again, that is plant and machinery as compared to the building. If it is a building cost, then what we'll be looking for is the availability of this structures and buildings allowance, which, as we'll discover when we look at it, will come at a much lower level of capital allowance available to you in any accounting period. Although we have not yet dealt with VAT, and we won't be dealing with that until chapter 25, we recognise that VAT from our introductory lectures is indeed a tax that is charged in relation to the supply of goods and services made by businesses there. So in relation to when a business buys an item of plant and machinery, we may usually be seeing a situation in real life where we'll be buying it from a VAT-registered business. And that therefore will require, when we buy that item of plant, for us to pay a VAT-inclusive price. So what we might have therefore is an item of plant that costs £10,000. We'll just make a note of that. £10,000 plus VAT, which would be at the standard rate at 20%. Therefore, the total cost would equal £12,000, VAT inclusive. So when you buy that item of plant for £12,000, £10,000 of it is the actual cost of the plant itself, but £2,000 is VAT. So it begs the question then as to what goes into the capital allowances computation. Now, we'll sort that in this next note in a moment's time, but usually in exam questions, they don't mix up the different taxes. So you would just be given a cost figure in terms of any item of plant or machinery that's been acquired, and VAT would not be mentioned. If, however, as they could do, if they so wished, they bring VAT into it, then what do we do? If our business is VAT registered, and what we call the input VAT is recoverable, again, our input VAT, that's what we suffer on stuff that we buy. If a business is VAT registered and the input VAT is recoverable on the purchase of an asset, then the VAT exclusive net cost will be available for capital allowances. Now, most businesses will be VAT registered. So when a business that is VAT registered buys from another VAT registered business this item of plant that had a VAT inclusive cost of £12,000, we would only put the £10,000 into the capital allowances computation. The other £2,000 worth of VAT cost incurred, will be recoverable through the VAT system. Now, you don't have to worry about how that VAT system works, not yet anyway. That awaits you in chapter 25. So, we as a VAT registered business buy an item of plant from another VAT registered business. If we are VAT registered and we're able therefore to recover that input VAT, we will get capital allowances on the net cost of £10,000. If, however, the VAT is not recoverable, Now, why would this be? As for example, on the purchase of a car, and in the vast majority of detailed exam questions dealing with capital allowances, cars will be involved. Why? Because there's lots of different rules that we need to know about cars. Cars will always cause us trouble, as probably you know well. Or, if the business is not VAT registered, then the VAT inclusive price will attract capital allowances. In relation to the purchase of a car, it is irrecoverable input VAT. We cannot recover the input VAT on cars in the vast majority of circumstances. And on that basis, if you cannot recover the input VAT, you're not going to get your money back for the VAT cost incurred, then you'll be able to claim your capital allowances on the full VAT inclusive figure. Okay. If, of course, our business is not VAT registered, we're only a very small business, as an unincorporated trader may be, buying smaller items of plant and machinery, then under those circumstances, as you can't claim back the input VAT, then yes, you can claim the capital allowances, again on the full, here, £12,000 VAT inclusive figure. So the first thing we had to do was to establish what is the qualifying cost of plant and machinery, and as we'll see later, the qualifying cost, if there is any, of commercial buildings that will rank the structures and buildings allowance. We will spend most of our time now, and certainly the first part of this considerable chapter, in dealing with plant and machinery. So in relation to plant and machinery, what capital allowance computations are done for these, what capital allowances are available. So we prepare a capital allowance computation for the accounting period of the business, maybe referred to as the period of account, whatever is the period for which the accounts have been prepared. Now, for any ongoing business, that will be routinely the accounting year ended, whatever that year-end date may be, a 12-month period. But for example, when a business first starts to trade, as we'll discover rather more about in the next chapter when we look at basis periods for traders there and trading income, we may not have from start date to accounting date a full 12 months. What we may have is we start on the 1st of July, say, and we want to prepare accounts to the 31st of December. So in which case we'll probably go a 6-month period to the next 31st of December. That would be the period of account. That will be the period for which the capital allowance computation is prepared. We'd have a statement of profit or loss for that 6-month period. We do an adjustment of profit for that 6-month period. We would also compute capital allowances for that 6-month period and deduct those capital allowances from the adjusted accounting profit to make it acceptable for taxation purposes, to derive then the tax-adjusted trading profit. If we did start on the 1st of July and we wanted 31st of December as our accounting period end date, then instead of going just a 6-month period, we might say, tell you what, we'll go 18 months and we'll do a long opening period there and have an 18-month period. In which case, again, for here in income tax, the unincorporated trader, you prepare the capital allowance computation for that opening period of 18 months. So that length of the period, although normally and routinely for any continuing business, it'll simply be a year end. It may be a short period, it may be a long period. But that is important because when we look at, as we will in a moment's time, the allowances that are available, the majority of allowances that we see, the two main types at least, are given on a per annum basis. There will be an amount per annum. So if you've only got a 6-month period or a 12-month period, then you must time a portion accordingly. But more of that in a moment's time. So prepare for the accounting period of the business, not the tax year. Again, we adjust up the accounting profit of the accounting period to make it acceptable for taxation purposes. In so doing, we disallow the depreciation charge, and now instead we prepare a capital allowance computation for that self-same accounting period, compute the capital allowances, and deduct from the adjusted profit to get the tax-adjusted trading profit. There are 3 types of capital allowance that will be available on our qualifying cost of plant and machinery. So it's going to be important for us, therefore, to know what they are. But we are aided here significantly by the vast majority of the information you're going to see about these allowances being given to you on your rates and allowances page. And we'll be looking at that in these notes in just a short while. But the first and main allowance that will be available, an annual investment allowance, something we'll know as an AIA from now on. Now, the AIA gives an allowance of 100%, i.e. the full cost of the qualifying cost of plant and machinery, 100% of it, and it's for a very big number, for the first £1 million of such qualifying expenditure incurred in, and here's the point about the length of the period, in a 12-month accounting period. So as we'll see in the next paragraph, clearly, if we do not have a 12-month period, we have either short or long, we either net down or gross up, we time apportion that £1 million to suit the length of that period of account. So if the accounting period of the business is other than 12 months, the AIA, as we said, will be time apportioned. For example, if we prepared our accounts for, say, a 9-month period, then we'd be entitled to AIA of £750,000, i.e. 9/12 of the annual limit of 1 million. If it were an 18-month period, you'd be entitled to 18/12 of 1 million, i.e. 1.5 million. Now that amount of allowance is based on the length of that accounting period, that period of account here. The date within the accounting period that the asset was purchased does not impact on the available AIA, nor indeed, as we'll see, will it impact on the available writing down allowance, which is the second one up on the next page of these notes. So all that matters in terms of the allowances available will be the length of the period itself. Firstly, here with AIA, it is only the length of the accounting period itself that may require the AIA limit of 1 million to be time apportioned. And again, as I said to you, that 1 million limit there is available to you within your rates and allowances page, but also that 1 million limit applies in our, obviously important to us, the Tax UK exam, regardless of the dates of the 12-month period covered by the exam question. It wasn't always that figure of 1 million. It isn't indeed now 1 million. That has changed. But for our purposes, in our exam, June 22 through to March 23, whatever the dates of the accounting period, whether now in income tax for the unincorporated trader or indeed for the incorporated trader later, the AIA limit is £1 million based on a 12-month period. AIA is available on the purchase of all plant and machinery except motor cars. Motor cars, as I said, are going to be the ones that give us problems, if anything's going to give us a problem, simply because there's more rules to learn. It's simple with plant and machinery. It's unlikely in real life that you go over a £1 million figure if you're an unincorporated trader anyway. It's unlikely you go over the AI limit of £1 million for a 12-month period. So basically, capital allowances computation in real life would be very simple. You add up the qualifying cost of plant and machinery in the accounting period, and you give 100% AIA on that. All of the capital allowance is immediately available. Now that, of course, is just a little bit easy for an examination question. So there's going to be other issues that are brought in, and more often than not, one of, if not the other issue in the question, is dealing with the purchase of a motor car, or indeed motor cars, where differing levels of allowance may be available. But what is not available is this, AIA. IA is available on all plant and machinery except motor cars. What we'll see on motor cars is most likely is that we'll be able to get something called a writing down allowance on an annual basis. In rare circumstances, there may be, and the third of the three capital allowances available, as we see when we go over the page, is a first year allowance. But if you did have expenditure in excess of the AIA limit, which may happen in an exam question, though seldom in real life, given a £1 million limit. If you have expenditure in excess of that AIA limit, or on the majority of motor cars, there will be one exception, will qualify instead for an annual writing down allowance, which again from now on we'll know as WDA. And over the page to look at what writing down allowance is. Now, as we said, for most businesses it won't be an issue if all they buy is qualifying plant and machinery that is available for AIA. It's 100% expenditure is available for relief. The full cost is immediately available in the accounting period in which that asset was purchased. So as we've said, the cost of most plant and machinery will have qualified for AIA, but that has not qualified for AIA will be allocated instead to a pool of expenditure. For the vast majority of plant and machinery that we buy, we will not need to maintain any separate individual record for capital allowance purposes of each of the 100, the 1,000 items of plant and machinery that we're bought over time. We'll be able, if necessary, to put them into a pool if we're talking about AIA wasn't immediately available on the full expenditure. So the cost of most plant and machinery that has not qualified for AIA, remember what that was, in excess of the AIA limit of 1 million, but more likely in our exam, most motor cars, will be allocated to a pool of expenditure whereby the idea of a pool, we pour all these in so we can do one single calculation of writing down allowance on one pool total, rather on 1,000 different items of plant and machinery. That would be a ridiculous exercise. So it's on one big pool. And that will be eligible for, again, it's an annual writing down allowance. So as I stress annual, the figures available are given per annum. An annual writing down allowance of either, more than one figure, either 18% per annum. So if again it was a 6-month period, the 18% per annum figure would be times 6/12. You time a portion based again on the length of that period of account, the accounting period in which the asset was bought. We do not time a portion either AIA or WDA on the date when you bought the asset within the period. The time apportionment is based on the length of the accounting period itself. Now it's 18% per annum if expenditure qualifies for the main pool. And the majority of plant and machinery in real life will be main pool expenditure. And therefore the 18% per annum would be available. But again, to make life more interesting in your exam, it is perfectly possible that the examiner will give you items of plant and machinery that do not get allocated to the main pool, but get instead allocated, as we'll see written here in a moment's time, to something we call the special rate pool. And it's special, sadly, in a bad way, not a good way. Because instead of 18% per annum, it's now only 6% per annum, only a third of the rate that would be available to main pool expenditure. 6% again per annum if allocated to the special rate pool. And as it's on an annual basis, it is also available on a reducing balance basis. It's not straight line, so you incur the expenditure, the bit that doesn't rank for AIA goes into a WDA calculation. You take your 18% or you take your 6%. Is it main pool? Is it special rate pool? get your tax written down value to carry forward at the end of this accounting period to the next accounting period. You then take next year's WDA based on that tax written down value, the reduced balance carried forward. It's not a straight line on original cost. Now we'll see in later notes the expenditure on plant and machinery that is allocated to the main pool, which I've said is most of it, and which other expenditure is allocated to the special rate pool. Basically, you'll see a list of items that are special rate pool expenditure, and effectively all other plant and machinery will go to the main pool. With the exception of, here's another very specific asset. Don't worry, this information is again provided on your rates and allowances. With the exception of new electric cars with zero CO2 emissions, they are perfectly clean, which attract 100% first year allowance. That's the third of the three types of allowance that we see. Here, this third one, first year allowance, as we've just said, new electric cars with zero CO2 emissions attract a 100% first year allowance, a one-off first year allowance. First year allowance, the first accounting period, the accounting period in which it is purchased. Now, because it's a one-off figure, 100% the total expenditure on that individual asset, that new zero CO2 emission electric car, the FYA is never time apportioned. So if you buy this new electric car with zero CO2 emissions in a 12-month period, in a 3-month period, in an 18-month accounting period, it doesn't matter. It's 100% allowance that you get. So that's one type of car, a pretty rare type of car there, though becoming, thankfully, that much more common. All other cars, we said, they don't get AIA. So what they're going to have instead, motor cars will qualify for a writing down allowance, then of either 18% per annum. Remember, 18% was the main pool figure. That was available for main pool expenditure. But 18% will only be available if CO2 emissions are between 1, obviously if it was 0, it's 100% first year allowance, but between 1 and 50 grams per kilometre. And that expenditure would be allocated to the main pool, and year on year, on a reducing balance basis, an 18% per annum reducing balance basis allowance would be available. You're writing down allowance 18% per annum. Or, and you can guess what's coming up here, if we're talking about CO2 emissions in excess of 50 grams per kilometre, the dirtier cars there, then what happens? It's only 6% per annum if those emissions exceed 50 grams per kilometre, and that therefore means that that expenditure will be allocated to this so-called special rate pool. Again, as I said, remember, cars do not qualify for AIA. They do not get AIA. New zero emission electric cars, 100% FYA. 100% FYA available, whatever the length of the accounting period in which they happen to be purchased. All of our other cars are then going to rank only for WDA, where again it's a CO2 emission issue, where as long as we do not go in excess, we do not exceed 50 grams per kilometre, then we'll have main pool allocation and an 18% annual writing down allowance available, again remember on a reducing balance basis. If the car concerned is CO2 emissions are in excess of the 50 grams per kilometre level, then it's special rate pool, and that means only 6% per annum available. As with AIA, as we've said, the WDA will be time apportioned where the accounting period is other than 12 months. Now that most likely is going to be in your opening accounting period, Obviously, a business could change its accounting date at any point and thus create either a short or a long period. But the situation in which you're most likely to find this is in an opening period. So if that opening period is 9 months, then as we've already seen, the AIA limit would be 9/12 of 1 million. It would be £750,000. And whatever you bought qualifies for AIA within that 9-month period, whether day one or the last day or any day in between that 9-month period there, doesn't matter. It's the 100% AIA that is available. And equally, when we deal with a car that was bought at some point in that 9-month period, it doesn't matter when. The WDA that will be available is based on 9/12 of the annual figure. I have seen over the years so many students, when they see an opening period, it's a short period, and what do? They time a portion and they take a WDA based on the period for which you own the asset. No, do not do that. The time apportionment, I repeat, is based on the length of that accounting period, not the date within the period that you bought it. So I'll not expect to see any questions on the Ask the Tutor forum dealing with that particular issue. Hopefully now we've got it. So we're going to look therefore at our first illustration here, where Richard commenced to trade, an opening period, on the 1st of January 2021 and prepared accounts to the 31st of March 21. Well, hang on a minute, that's not a full 12 months. That, of course, is just a 3-month period there through to the 31st of March 21 and then to 31st of March thereafter. So it'll be year ending 31st of March 22, then followed by year end, followed by year end there. What we've done here in this particular example is to identify accounting period by accounting period. We're going to be looking at 2 such periods. That opening short period there of 3 months and then the next full accounting year. And we list out the expenditure accordingly. What a question could do, of course, is just give you a list of expenditure without dividing it up between the accounting periods. That's what you've got to do. So you could have seen a list that said the 1st of January 21. Well, that's in the 3-month period to March, so you'd allocate to this accounting period. 20th of January 21. Again, it's in that 3-month period. You allocate to this period. But the next one is the 19th of May 2021. Well, that's not in the 3 months to March, so it would be allocated to this period. So I've given you there each accounting period with the purchases for that period listed. Do not necessarily think that you will get that. It could be, here's a list, the dates span more than one accounting period, and the first thing you have to do is to allocate those transactions. Here, purchases, but it could be both purchases and sales of assets that you have to deal with. We'll deal with that eventually in this lecture, or this chapter, I should say. And on that basis, you allocate those transactions to the relevant accounting period. Having established which transactions relate to each accounting period, you then look at what was, and simply here, it's bought rather than bought and sold, but bought within the period. And what have we got? We've got an item of plant for 220, computer equipment for 80,000. Now, both of those, therefore, will rank for AIA. They will both rank for AIA. That's normal qualifying plant and machinery. So what we have is a cost overall of £300,000. Now that, of course, is well within the AIA limit of 1 million. But wait a minute, I hear you say. This accounting period is not a full year. It is only a 3-month period through to the 31st of March 21. Therefore, your AIA limit of 1 million has got to be time apportioned. That is 3/12, therefore, of the 1 million. That will equal £250,000, which means here as the cost is in excess of that at 300, we'll be able to claim AIA of 250,000, the 3/12 maximum limit for this period. But the remaining balance of £50,000 will not be entitled to AIA. Well, it's normal plant and machinery, so what is it then available to in future accounting periods? We've had what we could for this period. It was AIA. What do we therefore get in relation to the rest of it? We get WDA will now be available. If we've had AIA, whatever we've had AIA on, here it will be equals £250,000 there, then that's it. We've got it. But if something is in excess of that AIA limit, or, as in the case of most motor cars, doesn't qualify for AIA, then we revert to WDA. So in relation to WDA, we'll then be able to make the relevant claim. So here we'll have, of that 300,000, 250 being eligible for AIA, 50,000 not, it will be eligible for WDA. But WDA could be either 18% per annum or 6% per annum. Well, 18% is for main pool expenditure, and all of your standard items of plant and machinery here are going to be main pool items. Again, what goes into the special rate pool, other than the higher CO2 emission cars that we've already mentioned back here. That's the only thing we know at the moment that goes to the special rate pool. But vast majority of stuff will go to main pool. That will be the case here. So 250 AIA, 50,000 into the main pool, and that will qualify for WDA. But again, main pool, it's 18%. But remember, that's 18% per annum. So again, time apportionment will be necessary because this period is only a 3-month period there. All right. What you'd also do here before you put, I say pen to paper, it's hardly that, is it, in the exam with a computer? But you look at the next period, and again, it's just normal, standard machinery, and that 30,000 will therefore attract AIA, because now it's a 12-month period, and that's a £1 million limit there. Well, we're nowhere near that, are we, at 30,000? So that would be full AIA. So it's this opening period which is the more interesting. So we prepare capital allowance computations, as we said, for the accounting periods, or periods of account for the unincorporated trader. The first one is a 3-month period. Now, having read the question, you'll know what expenditure you have incurred. And you know, well, always you will need, on the far right-hand side of your columns here, a column to record the allowances that are available to you. We've also seen here that we have expenditure that was in excess of the AIA limit, but would be allocated to the main pool. So we'll set up that main pool column as well. If we'd had expenditure that was in the special rate pool, for which AIA was not available, like the higher CO2 emission car, then we'd have set up a special rate pool column as well. But here only main pool. We then have, on the left-hand side of these workings, another little column which you can either just put a pound sign on, but what this column will be used for, and you can label it if you so choose, is to determine, one, any AIA, which is the only issue here, but also any FYA. So before working out what goes, if anything, into the main pool, we're going to record expenditure in this column here that will either rank for AIA or in turn would rank for first year allowance. Both are 100%, so that would take all expenditure out and claim your allowances thereon. Well, I say take all the expenditure out, other than in this circumstance, because the combined cost, as we saw, was £300,000, but the maximum AIA, as we saw, is only £250. So we claim our maximum £250. That goes over into your allowances column. There's the first amount of allowance available for this period. and that equally puts the remaining 50,000 into the main pool. Into the main pool where what then is available. We've taken the maximum AIA possible. What is not eligible for AIA is therefore eligible for WDA. It's in the main pool, so that's going to be 18% that we're talking in terms of, but it's an annual figure, so we're going to take 18% of this 50,000 in the pool, but then just take 3/12 of that. So hopefully 3/12 of 18% of 50,000 there will be 2,250. 18% of 50 would be £9,000. 3/12 of 9 would be 2,250. Deduct it here in your main pool. So we've taken of that £50,000 of expenditure qualifying now for WDA, we've taken 2,250 this period, giving us a tax written down value, TWDV, as we'll shorten that to carry forward, of 47,750 into the next accounting period. We've been able to claim 2,250 on that expenditure, meaning our total allowances available, a very large number, £252,250. That would then be deducted from the adjusted profit that you had, could have been given in the question, or you could have had to work it out for yourself there, the adjusted profit, and that capital allowance would be deducted from it. Now that, of course, is a very big number. If the amount of profit we had from our adjustment of profit statement wasn't that big, then it would turn that that currently adjusted profit into a tax-adjusted trading loss. That capital allowance, if it is bigger than the adjusted profit so far, will still be deducted in full to derive not a tax-adjusted trading profit, but then a tax-adjusted trading loss. But of course, it's Chapter 7 when we deal with the loss reliefs that are available in relation to that tax-adjusted trading loss. But yes, that capital allowance, however small or great, deducted from the adjusted profit figure that either has been given to you or you have computed for yourself to derive either the tax-adjusted trading profit or potentially, with that sort of number, a tax-adjusted trading loss. We now move to the next period to show what happens to an ongoing business. An ongoing business whereby it's a normal year end. How do we put together its capital allowance computation? Well, the first thing you do, and if it was just a continuing business in the exam, you would be given in the question the figures, and it could be figures of tax written down value. Figures of tax written down value that here are on the only pool we've got, the main pool. And that, as we know, is 47,750. It could be a tax written down value on a special rate pool that we've already mentioned, but we'll see the detail of again a little later in this chapter. There will be, again, much later in this chapter, other items of plant and machinery that are not pool assets and therefore have to be individually maintained, separately maintained, an individual computation for it. So any tax written down values brought forward have to be given to you in the question. We're looking at the main pool, quite obviously, special rate pool, possibly, and then some of those individual assets that for whatever reason at this point are not able to be pooled, are separated out. If there is one, you'll be told what it is. More of that later. Tax written down value brought forward to begin with. Then again, we deal with the additions of this period into our AIA/FYA column here. It was £30,000. Obviously no problem in terms of AIA. That's a full 100% that is available. And all of that expenditure is fully relieved in this period. no part of it to then go into the pool. But we do have that pool, its main pool. That means 18% allowances, and that therefore is what we now take. 18% of that reduced balance of 47,750, hopefully, if my calculator worked right, is that particular figure there. Add it in, get your total for the period. Again, what do you do with that figure? You deduct it from whatever was the adjusted profit off your adjustment of profit statement. Deduct it in deriving the tax adjusted trading profit. Okay, now just go back through that for a few moments, a few minutes, please. Make sure that you've understood where those items come from. This is your first exposure to the capital allowances computation, its structure, and the capital allowances that are available. Look back through that before we progress any further. Okay, just to finish off this lecture now, again, we've had our introduction to that capital allowances computation. All we'll be doing is just add other items, most of which we've already mentioned, like the special rate pool there, but adding other items in to see the different items that could possibly ever be involved in terms of a CA computation for this, the unincorporated trader. But again, just to put mind at ease, the capital allowance rates, this is the information that will be available to you in your examination on your rates and allowances page. Now, they won't always give you the labels that we have applied of WDA and FYA, but they do give you the information that you need. The first title, Rates of Allowance in relation to plant and machinery, and there's your main pool and your special rate pool, and those, of course, oops, what's that squiggle there? Those, of course, are your figures of writing down allowance. Remember, per annum. In relation to AIA, that one is labelled. We know it's 100%, and the expenditure limit is 1 million, again on a 12-month period. And we use that 1 million whatever dates the accounting period may be. Motor cars are the awkward little so-and-sos. To begin with, good news. If it's a new electric car with zero CO2 emissions, it's 100%, and that is your first year allowance. We haven't seen one of these yet. Obviously, in our next lecture, no doubt we will. But then, of course, if it has CO2 emissions, it depends whether or not they exceed 50 grams per kilometre. If they do not exceed 50 grams per kilometre, it's a main pool item and an 18% annual WDA is available to you. Or if it's over 50 grams, it's 6%. And again, those are your writing down allowance figures there. So that information is made available to you. Again, the probability is once you've gone through all of this, once you've practiced through your revision period, you'll know those numbers anyway. But don't worry, they're there should you need them. Just to complete this, therefore, as can be seen from this information, it's therefore essential for you, the student, to know what type of allowance will be available for each asset acquired during the accounting period of the business. As we've seen again above, new electric cars with zero CO2 emissions, that's 100% FYA. Otherwise, plant and machinery, with the exception of cars, will qualify for AIA with any excess expenditure over £1 million per annum, and cars then qualifying for writing down allowance. As we know, at either 18% per annum if it's main pool, or 6% per annum if it's special rate pool. Now, we've said that for a normal 12-month period, at least for an unincorporated trader, it's unlikely that we go over £1 million worth of qualifying plant and machinery, so you'd expect everything to qualify for AIA. But we put it in an opening period context. We had a 3-month period in that example there, as you know. That cut it down to 250. We had 300. Therefore, AIA limited, and the balance then went into the pool. There it was the main pool in relation to your available WDA. Now, if we had a mixture of expenditure that qualified for AIA, but it exceeded the AIA limit, and the mix of expenditure that we had was a mix between what was eligible for 18% writing down allowance and what was eligible for only 6%, the special rate pool expenditure. If we've only got, like in that example, £250,000 a moment ago, or otherwise £1 million, if the expenditure for the period is in excess of the AIA limit, and we have a mix of, now this is again expenditure that would have qualified for AIA, so we're not talking cars here. So we have expenditure of that is main pool, that is special rate, a mix of the two, and it exceeds 1 million. So if you only got 1 million, to which expenditure would you apply the 1 million? Because anything left over would then go into the relevant pool, main or special rate, and only thereafter qualify for writing down allowance. And that's what we've got here in this note. Now, hopefully you'll be able to work it out for yourself as regards which expenditure, main pool or special rate, you would prefer to have the AIA on, and least want the WDA on, because WDA is at two different levels. So here you go. Expenditure qualifying for AIA, if it exceeds the AIA limit, then the AIA should be allocated firstly to special rate pool expenditure before main pool expenditure. The reason being, any excess over your 1 million or whatever your relevant AIA limit may be will then only attract 6% WDA in the special rate pool, whereas 18% is available in the main pool. So it's therefore necessary to know what expenditure is excluded from the main pool and instead allocated to the special rate pool. But if we've got that mix of expenditure and it's in excess of the AIA limit, whether the full 1 million or some time apportioned reduced figure like 250, then the special rate pool expenditure, because anything left over will only get 6% writing down allowance going forward, we'd like to get as much allowance as we possibly can now. So it therefore will take the first available amount of AIA. And only then the main pool expenditure will come in for AIA, and any excess then above your income, above your AIA limit, will go to the pool, because at least that will get 18% per annum going forward rather than only 6%. So appreciate therefore what that rule is. But of course, we now need to know what expenditure will rank in terms of special rate and not unfortunately qualify for main pool. So in between now and next time, what I'd like you to do is obviously to firstly go through what we have already covered in this particular session. Make sure you are comfortable with it. You know what the allowances are. You've got your rates and allowances there in front of you. You know what to apply and how to apply it. You know the structure of the capital allowance computation, at least so far. And then have a little read through this to become familiar with the type of expenditure that would be allocated to the special rate pool. That's where I'll pick it up next time, where I'll go through that and just say a couple of things about it before then we move on to see examples involving it. See you next time.